Okay, welcome to the Finance and Claims Committee meeting for Thursday, January, moving ahead, January 13th, 2022, starting at 7:01 p.m. First item is the call to order and the roll call. We have on the call council members from the Finance Committee, David Hooverman, Tom Keegan, John Kites, Jen McMurr, Nora Najelski-Eichner, Diana Revelous, and myself, Greg Burnett. So we have a full quorum in the entire council committee is here, which is great. Item 3 is public participation. I know we did not receive any emails as it relates to this meeting. Is there anyone dialed in from the public that wishes to speak? I don't see anyone. So at this point, I'll close public participation and move on to item 4, which is approval of the minutes of the finance meeting dated December 9th, 2021, regular meeting. Can we receive a motion? Diana Revelous, councilperson, thank you. In terms of corrections, deletion, changes, I know there's one, well, there's two throughout the entire document. Council member David Hooverman's name is spelled incorrectly. There's 9 that I counted, 9 locations where it's spelled incorrectly. It should be Heuvelman. So if we can make that correction throughout the minutes. And then also on page 2 of the minutes, if we look at the 1, 2, 3, the 4th paragraph down where it says 2, Mr. Dakowitz said since March of 2020, he and Ms. Biagirelli, that needs to be spelled correctly. There should be her name, Biagirelli. So those are the only 2 corrections I saw, minor typos to names. Was there any other changes, corrections, deletions? Okay, seeing none, all those in favor of accepting the minutes as amended, so by raise of hand, it is unanimous. Oh no, we have, let's see, the count is Greg Burnett, Nora, Tom, David, John, and Diana. All those opposed? Any abstentions? We have 1 abstention, Jen McMurr. Thank you. Moving on to item 5, which is we'll cover 5, 6, and 7. Item 5 is the Claims Committee report as of January 13th, 2020, followed by the narrative as of January 13th, 2020, and then the monthly tax collectors report dated December 21st, and I will
maybe 2022
December 2021 for the tax collectors report.
No, when you said January, you said 2020, and I thought it might have been 2022.
And you are absolutely correct.
I'm sorry, I couldn't hear you.
No, I won't say that again. Let me share my screen so that we can follow along as our tax collector takes us through. Excuse me, wrong screen. 1 second. Here we go. Okay,
Okay, can you hear me?
Lisa B., the floor is yours.
Thank you. Can you hear me okay?
Yes, we can.
Okay, perfect. Good evening. The Claims Committee report for this month is for information purposes only. It does not require a vote because there's nothing in excess of the threshold. So we provide it for your information. It's mostly motor vehicle refunds that were issued for motor vehicle credits on vehicles that were gotten rid of. Moving to the narrative and the monthly spreadsheet, I'll just lump everything together. As of the end of December, we're halfway through the fiscal year. And we collected 62.91% of the adjusted levy, which was ahead of where we were last year. But it's right in the middle of the collection period. So being ahead won't really count for anything until we get to February, but at least we're not behind. We're now in the middle of the collection cycle. The last day to pay the currently due taxes is February 1st. As was noted, you can wait until that day to pay. That's perfectly fine with us. A lot of people have been paying in December and January. However, we've been pretty busy. We have an arrangement set up where individuals who want to pay in person may also choose to pay at various bank branches in Norwalk. There's 10 participating banks. That helps us with our foot traffic at the City Hall campus. You can mail your payment, you can pay online, you can pay over the phone. We try to make it convenient for people. But the collection period is going on in earnest now. Unfortunately, we did have to scale back our office hours in our office in room 105. When I wrote this report on the 7th of January, I was noting that our office hours are 8:30 to 4. This week we had to scale it back, and our office hours are presently 9 a.m. to 3 p.m. We're very shorthanded at the moment. We have half of our staff is out sick. And we cleared it with Mayor Rilling and with our personnel department, but for the time being, we had to scale back our in-person transaction window. What we're also doing now, in addition to the collection cycle, we're actually still doing some cleanup work on the tax sale that we held in October. And we're doing other enforcement, including we've issued about 24 alias tax warrants, which are served by a state marshal to businesses that owe past due business personal property taxes. So that's underway. We're going to do some more as the year progresses. And we're also doing a program with our health department where you are not permitted to renew your health permit if you owe past due taxes that are more than a year in arrears. So we coordinate with the sanitarians in the Department of Health. Anybody who was issued a health permit has to bring their back taxes current. We also do a wage garnishment for Board of Ed and City of Norwalk employees who may owe past due taxes. We send a notice out first and give them a chance to settle up with us. And if they fail to do so, we do a mandatory wage garnishment. So we're working on those things as well as getting through the current collection. But in terms of regular work, COVID or no COVID, we're really doing all right. We're right where we need to be halfway through the year. And I'd be glad to answer any questions that you may have.
Thank you, Lisa. Any questions as it relates to the claims report, narrative, or monthly report? Okay, I see none. And just want to thank you and your team. We know it's a tough time. And as you mentioned, you have some staff that are out, but you're still keeping the cash register open. So we greatly appreciate that, all the efforts that you and your team are doing.
Thank you.
Thank you.
It's our pleasure. Thank you.
Great.
Oh, question.
Oh, question. Yes, Diana.
You hear me? You can?
Yes.
Okay.
Yes, we can.
Okay. This computer just got fixed. So I just wanted to know though, is there a list of those banks for people to easily access?
It's on our website. It's within the city of Norwalk, Fairfield County Bank, Patriot Bank, Webster Bank, Norwalk Bank and Trust, and M&T and Bankwell. And there's 10 branches, and they're all listed on the website.
Awesome. Thank you. Good for having that off your head.
I was trying. Thank you.
Thank you.
Okay, great. Thank you again, Lisa, and your team.
You're welcome. We'll see you next month then.
Yes, absolutely.
Okay.
Moving on to item 8, which is to receive Oak Hills Authority's monthly financial statement for November 2021. And we have with us the Vice Chairman of Oak Hills Park Authority, Mike DePalma, to take us through the update. Hello, Mike.
Hey, how you doing? So it's obviously kind of the downtime for us right now, although we did have some good weather early on in November. So our net income was actually about $18,000 ahead of budget. So we still have a good amount of cash on hand. This number is actually significantly lower now. It's showing 568 on here as of November 30th, 568,000, but we did make a payment for the continuous cart paths, which were completed in December, which will start generating revenue as soon as we open back up. So that'll be, that was a very smart investment. We did approve updated rates in December. Pretty minimal rate increases, $1 per round. The season passes were renewed it was a pretty close vote, but it did pass in order to continue the those seasonal passes. So those were approved as well. And we limited it to 50. As of last year, there were 75. We limited them to 50 to try to alleviate some of the issues we were having with people saying there weren't enough tee times available because all the season pass holders were taking them over. And as of Monday, we've sold 39 of those 50. So I can't anticipate, I have to anticipate we're going to sell all 50 of those passes. But that's, those are the basics of it. Anybody have any questions?
How's the situation, the burn rate, as we go through another few months of winter before we open up for the spring?
We're going to be plenty good in terms of cash flow. The influx of cash that we got from the 39 season passes really does help. So we'll be well in the black before we start the season. So as opposed to previous years, we're in very good shape financially to cover the float for the off season, and pray for some nice weather in March so we could start generating some revenue.
Great, thank you. Any questions for Oak Hills? Okay, I guess everyone's happy.
All right.
Okay, great. Thank you, Mike, for appreciate the update.
Awesome.
And
Thank you so much.
We'll see you next month.
Yep.
Okay, that moves us into item 9, which is our Chief Financial Officer, Henry Dakowitz, will take us through our current capital budget. We had requested that we receive an update as to each line item and how much has been spent, how much is still available. Those spreadsheets were sent out late this afternoon for your review and continuous review. We've had dialogue, consistent dialogue, as it relates to concerns with the capital budget, current capital budget, and in particular, future spending, because of the assessment, and I know Mr. Dakowitz will take us through this, not trying to create a situation where we're spending more than we can borrow, and create a stable financial posture that will be looked favorable by the rating agencies, and also maintaining our AAA bond rating that we have, which is really a great thing to have. So we have to make some tough decisions in terms of what projects we definitely prioritize and need to take forward and what projects we might have to put on hold, as well as what projects we might have to say we have to extend out or may not be able to do in the immediate time. So with that as a backdrop, I'll turn it over to our Chief Financial Officer to take us through where we're at currently with the capital budget.
Thank you, Mr. Chairman. Really appreciate the focus on this. The issue, to be very technical, is when I walked in almost 3 years ago, I discovered that we had many capital projects that were approved for which we had not yet borrowed funds. Now, there's a reason for this. The IRS has rules that when you are borrowing money on a tax exempt basis, they, in essence, subsidize our borrowing. The classic example, let's assume interest rates are 5% and individuals are paying a 40% tax rate. So if they buy a taxable investment and they earn 5% on their money, they then have to pay 40% of that or 2% to the federal government in tax. So they are earning a net amount of 3%. What the federal government says is, we think you're doing a good government purpose. We want to encourage you. So therefore, we will allow you to issue tax exempt borrowings where the investors are not required to pay federal income tax on the investment earnings, the interest they earn from you. Consequently, in a case where bonds are trading at 5% and the tax rate is about 40, we can issue tax-free bonds at 3%. The investor has the same 3% after-tax return, but we're only paying 3%. The federal government is subsidizing local governments issuing tax-free bonds. While we do that, the government says, we don't want you to take advantage of us because you could borrow at 3% and you can invest in US Treasury securities at 5% and earn what is called an arbitrage advantage. So the two rules are basically, you're not allowed to borrow more than you need for a project, and you're not allowed to borrow for a longer period of time than is reasonably necessary to use the funds to, let's say, construct a structure. So if I want to build a bridge and it costs me $100 million and I can do it in 2 years, I am not allowed to borrow $150 million for 4 years, because when those bond proceeds are not being spent, I can invest them and earn that advantage over the federal government. And there are a lot of rules, and I would have to do calculations that say, what did I do with the unspent proceeds? Did I make a profit? If I do, I have to fill out a tax return and pay the differential to the government. So that is a reason why we might authorize bonding for projects, but not borrow them immediately. What Chitsame and I instituted probably 18 to 24 months ago is every quarter we go out to every department head that has capital projects. It includes Alan Lowe and Jim Giuliano, who manage the Board of Ed's construction programs, Department of Public Works, anybody who has capital projects. We say, please tell us what your expected cash flow is for the next 2 years, quarter by quarter. And the reason we do that is I'm trying to balance two needs. One is, I don't want to have to halt a construction project when they have a purchase order, they have an invoice, and I don't have bond funds available. At the same time, I don't want to run afoul of the IRS and have too much money. So although we approve projects through our capital project process and capital budgeting, I borrow money based on expected cash flows. So we ask them, how much do you expect to spend quarter by quarter? How much reimbursement do you expect to get? Because many of our projects have state reimbursement. And how much do I have to have net to cover these expenditures? And that is what informs me as to how much money I borrow. I would have loved to borrow everything in the last 18 months. Interest rates are very low, but the government won't allow me. So I've done a calculation now for 2 years with Chitsame's help. And that's what I have in front of you now. We use the data as of September 30. We look at both active capital projects that are not completed, and we look at our cash on hand from previous bond issuances. How much bond proceeds do we have left to pay for these projects? So if you have a copy of the documents in front of you,
Henry, hate to interrupt. Do you want me to display it?
if you could, that would help, Greg. Thank you.
Okay, which one, which schedule?
This is the summary schedule where it says summary statistics. It has 5 columns of numbers.
Okay, I will. Thank you. And also, while I have the floor, I just want to acknowledge Chitsame Lamb on our meeting, our comptroller, and also want to welcome Tom Ellis, who is the budget manager director. Tom has just started at the beginning of January, so welcome, Tom. And
Thank you.
great to have you on board.
I wanted to introduce Tom. Today is his 9th day. So he's still 009 and he has a license to kill, but by tomorrow he loses that. Tom, maybe you want to talk a little bit about your background just so that people know.
Yeah, sure. I won't take up too much time. Good evening, everyone. I have several years of municipal experience, a couple different towns in Connecticut, most recently. The formative years of my career, and most of it were spent with large investment banks, both Midtown Manhattan, as well as Stamford. My final stint in the private sector was with RBS, which became NatWest Markets, mostly as a controller. I'm always specific to say a controller, not the controller. I was one of hundreds of controllers, basically doing the daily P&L for salesmen and traders, over the course of their institutional trading day. So learned how to get a pretty thick skin pretty quickly dealing with those types. But I'm enjoying my time in the municipal world. It's a nice change of pace and learning a tremendous amount. On the personal side, I have been a Norwalk resident for 25 plus years. I have 2 older kids that went through the Norwalk school systems and are doing well as adults. And I also have a 10-year-old, a 5th grader at Marvin School, who's doing very well at school. And we have enjoyed the school systems here, and I enjoy living here, and looking forward to contributing and helping my hometown, my home city, whatever you want to call it, to greater pastures.
Welcome.
Thank you.
Thank you.
Thank you for joining us.
So between Chitsame and Tom, we're almost at full strength on the financial team, and we're very excited about moving forward in that regard. So here is a summary schedule. Greg, if you could blow it up a little. Yeah, okay. So let me explain how this schedule works. Again, all the data is from September 30. So when I look at the Board of Education, I look at the remaining budget available to spend. So there might have been a project that had $20 million authorized, and 5.75 million have already been spent. So the remaining budget available to spend is 14.25. Everything is in millions. Future reimbursement, we have numerous projects, especially in public works and in the schools, where we expect reimbursement from the state. Again, very similar. Maybe we expected 5 million in reimbursement. We've already received 1.74 million. So net, we expect future reimbursement to be 3.26. If I deduct the 3.26 to be received from the 14.25 I expect to be spent, I have a net amount which has to be bonded of $10.99 million. We need to come up with that amount of money to satisfy previously approved projects. So the Board of Ed, obviously the school program is the largest, and that's where we have a net 187 million. Now, normally we record our projects in Munis, our accounting system, Chitsame is in charge. Normally, we record our projects gross minus expected reimbursement to get to the net. The one project we didn't do that for was Norwalk High School. So we just netted it out and put it in as approximately a $50 million obligation. But in true fashion, the gross expenditures are going to be 189 million. So I added 138.7 to the available to be spent because I have to finance it. There's also a timing issue that we may lay out the money and not get reimbursed for months or years. 89% of the reimbursement we normally get within a month or two, but 11% is held back. And after the project is completed, 1 or 2 years subsequently, the state audits us and then determines the final reimbursement. And that's why it's just important to me to gross this up. So I add the 138.7 because we're going to have to spend that. And I add the 138.7 we expect to get reimbursed. It has no effect on the total amount needed to be bonded. So for the Board of Ed, we've got $198 million. Vast majority are school projects. Greg, if you could just scroll down a little bit, please. Thank you. I then look at Norwalk and I start with Public Works. Now, Public Works has projects which usually get completed 18 to 24 months after they're approved. This is our annual sidewalk and pavement and all the normal things that Public Works has to accomplish. Well, right now we have 36.19 left to be spent, 2.6 reimbursed, 33.57. Parks and Recreation, about 9.5 million. Everything else is about 10.5. So our total for parks, for DPW is 53.5 million. I then go down and I went to the other large projects where they've already been approved and they're big money that we have to identify. Combined Dispatch wants to replace their communication console for about $14 million. POCO still has $4.3 million authorized to spend. Historical Commission, Lockwood Matthews Mansion, 2.7. The Redevelopment Agency, 277. The library, 2.45. If I take everything else in the city, it's a net wash. So total city, non-DPW is another 26 million. So if I look at the city, 53.6 plus 26.02, I'm at 79.62. I take the 79.6 for the city, I add the 198 for the schools, and I get 277.71. What we have to spend minus expected reimbursement. Now, the way we've borrowed money, and because of the cash flows, dependent on which projects work, we just have a pool of money which we apply based on the department head's expectation of cash flow. So these little squiggles to the right says for the city and the Board of Ed, 277.71 expected future bonding as of September 30. Well, we had 73.58 million of prior bond proceeds waiting to be spent. So 277 minus 73, we need to raise 204 additional dollars, 204 million in future bond issues to finance everything that's already been approved on the city and the Board of Ed. Now below it, we have our enterprise funds. In accounting, they're called enterprise funds because they look like a regular business. They have revenues, they have expenses. And in a government agency, we try to set the rates or fees such that the agency will break even. However, when they borrow long-term, I borrow on their behalf. I borrow the money, they use it, and then they pay us back the debt service, the principal and interest payments. But if I borrow their money, I'm using up my debt capacity. Right now, the WPCA, Water and Pollution Control Authority, has 29.66 million available to spend. And we just went out and borrowed for them a year ago. So they have 15.25 left, a net 14.4 future borrowings. The parking authority is similar. They get parking fees. That covers their operating expenses and the debt service. 2.79 to spend, 1.7 in the bank, 1.1 if you would. So we have another 15 here. So if I take the 204 plus the 15, I'm just about at $220 million. And this is a very big obligation. Everyone has already gone through the process of proposing, recommending, and getting approval for all of these projects. This 220 million I've identified 2 years ago, last year, and I said, if we are to try to keep our AAA bond rating, we should look, as Greg said, can we cancel some projects? Can we just say, sorry, priorities change and we just can't afford it? Can we take certain projects and slim them down? Maybe there are 10 components to them, and we say 5 or 6 of those 10 are really valuable, but the other 4, let's cut that out to save some money. My experience, I've seen projects that are spec'd and then bid like a Cadillac, or today maybe we would call it a Maserati, okay? But really, a Chevrolet or a Volkswagen might be adequate to functionally get the job done. We don't have to get all the bells and whistles. Maybe we can't afford them. That's another way to save money. Last, can we stretch the projects out in time? Right now, every year, we have about 20 million of bonds maturing. So we pay them off, and if we issue 20 million new bonds, we still have the same outstanding debt. We're swapping one for the other. So if we stretch out the timing of these projects, we might be able to fit them under an umbrella. So it's 20 million a year now. In a couple of years, that'll drop down to 16 million, 14 million, 12 million. But by stretching things out, we're taking our borrowing capacity and allowing us to try to fit everything under an umbrella. I will tell you that I've had discussions last year during budget process where I said to both the schools and city agencies, I said, can you do something to help us on this program? And there was almost no response. Public Works tried to stretch out some of their projects, but they can only stretch it out by maybe 1 year. The Board of Ed pushed out some of the school projects, maybe by 1 year. It's too little. It doesn't make a difference. So I am resigned to assuming that this $220 million I have to borrow over 7 years, max. That's $30 million a year. If I have to borrow them over fewer years, it's even more. So I just feel out of the gate before this year's capital program, I have to borrow 30 million a year. John, did you want to comment?
Yeah, we do have, John has his hand up for a question.
Yes, Henry. We had a bit of good news yesterday at Recreation and Parks where we received the grant, $5 million grant to work on Cranberry Park, and they had projected or on their 5-year plan, over $1 million per year over the next 5 years. And I've been seeing it other places as well, through ARPA funding and other outlets of revenue that came in unexpectedly. Do you see this offsetting your numbers? Are you accounting for all these varying income sources we've been receiving as of late into your projections?
I'm going to bet you that 5 million was for a new project at Cranberry Park, not an existing one. Okay. So this 220 may not change. I just sat down with Parks and Rec and the whole Public Works team yesterday, going over their requests for capital projects. Look, every dollar helps. 5 million in has got to help. The problem is we almost always take the money and spend it new and fresh. When the ARPA money was announced, I said it would be nice. The first priority was to try to help the taxpayers and alleviate the budget increase last year. And we also have some money earmarked this year, half as much, to alleviate the tax pressure in the community because of COVID. However, we have so many projects. I mean, this is really hard and challenging. There are many projects, there are many things that are very worthy. The problem is we don't have enough resources for everything. And I wanted to try to use some of the ARPA money to pay some of these old projects. The problem is we then came up with flooding mitigation was a critical need across the city. So the money that I was counting on, I gave up. I said to our head of public works, Anthony Carr, look, here's 15 million. Go do your flooding mitigation. You know, do the design, do what you have to do. That has great value across the city. And that's the wise investment. You're always trying to invest the money to get the biggest return on investment. The problem is, how do you calculate that? Is it a question? I think if we have fewer flooding zones, then the value of the properties go up, and then that helps us with our grant list.
Henry, so I mean, I guess you're saying to me, all this funding that we've been receiving is almost a drop in the bucket, and in the big picture isn't really offsetting any of our, major capital projects. That pretty much the gist of it.
We got 39 million in ARPA money. If we used every dollar, we'd be down to 180 million.
Okay.
Okay. If you recall, the financial advisor to the city, Bill Lindsay, and I did an analysis comparing AAA cities in Connecticut to AA cities. And we had determined that 400 million was kind of the magic number, that if we go above 400 million in debt, given our finances and our grant list, we're in danger of losing our AAA. We are now at 180 million. That says 120 million away from the 400 million. There's another ratio that's critically important. It's the ratio of debt service to our total operating expenses. Debt service is what you would call the principal and interest payments you make when you pay off a mortgage or when you pay off a car loan. So we call that debt service on our bonds. Debt service for AAA cities in Connecticut is 10% or less. We are at 9.5%. So when we keep increasing the amount of debt on our books, we're going to have a problem. Compounding that, 18 months ago, we borrowed 30-year money, about $50 million at 1.75% interest. And part of that is because we're tax exempt. Part of that is because we are AAA. Last summer, we borrowed another $48 million, 30-year bonds, and we paid 2%, 2.0. You've heard about inflation. You've heard about the Fed saying we're looking at 3 or 4 rate increases next year. So I've asked Bill Lindsay to do a projection that says if we keep increasing our borrowing, and if interest rates go up, and if we lose our AAA bond rating, we're going to have to pay a premium. What will that do to our debt service? I guarantee you, we will go from 9.5 to 13.5 or 15 in the next 5 to 10 years. Okay, I will tell you right now today, based on everything I know, if we don't make any changes, we will lose our AAA bond rating in 2 years or less. I guarantee it. Guaranteed. And I remember when I made the presentation to the new council members, I don't know, a month or two ago on a Saturday, and someone said, well, what's the significance? Well, the first thing is it's a very negative signal to the rating agencies and the investors. It says, if you're piling up so much debt, we're taking a greater risk that you may not pay us on time. Okay. Secondly, in order to compensate them for that risk, they charge a greater interest rate. So we're going to get penalized for that. Now, my other problem is I look at the grand list. If we're increasing our debt and our interest rate at such a fast clip, and we're only going up in grand list 1% every 5 years, I don't see where the big growth is going forward. And you can make different assumptions. You could say it's every 5 years when we do a reval. But basically, our expenses are going up much, much faster than our grant list. So the reason we're in good financial shape now is because we have a very high rainy day fund. The rating agency says that's great. When things are bad, they've got a cushion. And it was true. We lived through COVID with that. We didn't lay off anybody. We didn't furlough anybody. And we got through. Part of that was because we had a rainy day fund. And at the same time, we lived within our means. We could do tax increases that were reasonable, especially compared to other cities. But what's going to happen is, with all this increased debt service, because of more debt and higher interest rates, the debt service line will either crowd out our budget or our taxes will have to go up at much faster rates. And that causes all sorts of other problems. So it's interconnected. I hope I was clear without being too confusing.
Yes, Councilperson Najelski-Eichner, Nora.
Thank you. So I have a couple of questions. Henry, apologize. There's a kid's video in the background. A couple of questions. First being the how much could I understand? I very much understand the point you're making about the federal government not allowing us to take more than we could use. At this moment, when interest rates remain very low, is there an ability to essentially do what I would think of as a balloon bonding right now, maximize what we get out while our interest rates are extremely low? Do we have projects that could do that if we could get that bond issued? You know, so do a 40 or 50 million dollar right now, jumpstart what we can, jump on top of the low interest rates before they begin to go up next year.
I would say operationally, we get into a capacity issue. We can't build 3 schools at the same time. We can't do everything at once. There's a limit to what we can handle. And in fact, the schools are usually 3 or 4 year projects. So the way the IRS works is they have something called spend down rules. And you have to spend a certain amount of what you raise each year, or else you fall victim to their rules. And the worst penalty could be that they declare our bonds taxable. So everybody who bought tax-free bonds and thought they were paying tax-free, now the bonds are declared taxable because we violated these rules. And we sign a statement whenever we borrow money that we will comply with all these rules. So I am reluctant. I am happy to borrow what I think is prudent, but what we've seen historically, given this long list of projects, we don't do all the projects so quickly. We'll take a year just to do the design, and then we sketch it out, and then we do everything else. And I don't have the confidence that if I borrowed the money, we would hit the spend down rules appropriately. That's why I ask every department head for their projections. And I think there's a real operational challenge and risk of trying to expedite too many of these projects.
Well, and I think that's a little bit is what I'm asking is, has that question been asked? Has there been a sort of a message to go out to say, you might be in a use it or lose it situation? And if that is the situation, could you use it? What would it look like to expedite it? Is this something you're capable of doing or not? And again, that's not a question necessarily for tonight, but I think that is a question to think about going forward. The other thing, so I was the one who asked the question about AA bond rating, and I'm going to continue to push back on that. I've done a little bit of research on it, and I'm not an expert in this at all. But my takeaway is that at the current interest rates, and again, I recognize that interest rates are likely to be going up quite a bit, but if I'm doing the math correctly, at the current interest rates, we're looking at somewhere in the neighborhood of 150 to 200,000, not million, but thousand additional in interest on a AA bond rating over a AAA bond rating at current rates.
Per year, maybe. Per year,
Sure.
over 30-year bond.
Sure, but right. But I'm saying, but that is, I mean, in the scheme of $50 million, that's not a lot of money. So again, I want to have I think we should have a frank conversation about, I understand what you're saying about the risks, but also thinking about the benefits, right? Part of why our capital project list right now is so large is because the city underfunded its capital projects for decades. If you talk to DPW about the flood mitigation, there are literally the problems they're working on now are problems that have been known in some cases since the 70s. We have not done the work, so we didn't pay for the work, but now we're in a problem where our infrastructure has seriously deteriorated. So at a certain point, the things have to be done. And if the question is, getting them done sooner actually saves us more money in the long run, is that a valid choice? Is that a choice we should consider taking the risk of to get it done now before we have further deterioration? So again, I'm not necessarily expecting you to have an answer to that, but I am raising it sort of to the committee as the kind of issue that I do think we need to think through strategically. There are costs and benefits. Having a AAA bond rating is great, but if we have a AAA bond rating because we are not providing adequate services, or because we are pushing down the road things that are going to become more and more expensive the longer we wait to repair them? Are we going to have more roads collapse because we haven't repaired the bridges because we waited decades to fix known problems? So that comes at a greater cost. So anyway, that's sort of, I just want to, I think it would be very helpful as you do your analysis going forward, particularly in this odd moment we're in of low rates while we see larger rates coming. Are there things we should jump on now to take advantage there? And that would be helpful to hear your perspective on.
No, I appreciate that. I would also say what ultimately has to be evaluated is the tax increases. If you have tax increases to pay for these things, that will be accepted by the community. So yeah, I'd love to borrow money at a lower rate. I'd love to fix things today because prices keep going up every year that we put it off, and maybe we have some real problems because they fall apart because we didn't do it soon enough. So those are the trade-offs that should be evaluated. Absolutely on target.
Oh, yes.
Hey, thank you, Chairman Burnett. Henry, just to clarify something you said before. So slipping to a AA bond rating, also what comes with that is the increase in the debt service, correct? Is that what you were saying before? So we would,
The interest
or maintaining where we're at right now with the AAA bond rating, and borrowing to our limit takes us into this higher debt service.
Well, when I say higher debt service is composed of two parts. What's
Right, I
the
understand that.
amount of debt and what's the interest rate? Going to a AA increases the interest rate portion. And obviously, if we borrow 50 million rather than 20 million, the debt service would have to go up and accommodate that.
Do we have more room to borrow if we're at a AA? Is that what I'm getting from this?
I
Do you
could
have more cushion?
borrow as much as you want to spend. Okay, we are a good credit. I have turned around 2 counties where they were below investment grade, which is BBB. And what happens, and the reason why that's a real big jump in interest rates, is that when you're not investment grade, insurance companies and mutual funds may be prohibited from buying your bonds. So if you have fewer buyers bidding on your bonds, you're going to pay a higher interest rate. We have the capacity to borrow. We're a good credit. We've never missed an interest payment. So that's not the issue. The issue is, how do we pay for it? And another point I would add, the schools, we used to only borrow for 15-year terms, which is pretty conservative. As I came in here, I saw that we were building schools that are going to hopefully be in service for 40 or 50 years. Financial theory says match your asset with your debt. So I said, why can't we borrow 30-year bonds? And that's what we did on the school projects. That gives us greater capacity because on the debt service, if I'm paying it back over 30 years, the debt service per year is smaller. But obviously, you're paying for 30 years, so your total interest cost is higher. So borrowing for 15 years is a good discipline. And except for the schools, we will have to borrow at no more than 15 years because most of the other assets that we are buying or borrowing for have useful lives of 15 years or less. So they will increase the debt service even faster.
Our current debt service in this fiscal year is 9.5%. Is that what you said?
It's 9.5% of our total operating expenses.
Right.
We're-
What's your, right now, I know you're working on the budget, you're not there yet, but what's your projection if we were to stay status quo going into fiscal year 23?
Status quo meaning not borrowing?
Let's say we didn't, let's say we borrowed the same amount of money as we borrowed last year. Hypothetically,
I think the debt service will be going up. It'll be
it'll
going
go
up
up. Okay.
faster than the rate of expenses. We are trying to control our expenditures. We don't
Yeah.
have a number yet, but the debt service is going up faster. And that's why that ratio will be going more and more against us.
Okay. Thank you. I appreciate that answer.
You're welcome.
Yes, Jen?
Can I just ask, I don't know if this is a discussion for right now, but I'm curious how much we have in our rainy day fund right now and how much you recommend staying in the rainy day fund.
Well, it just so happens, I was working on that today. Hang on one second. I don't have it handy. I apologize. The rainy day fund is healthy. But I will say I recommend that we don't touch it. Okay? The rainy day fund is viewed as one of the most positive, favorable things by the rating agencies. And substantively, it really helps us for rainy days, like COVID, if we lose a major employer, if we have a major physical catastrophe, a hurricane, a flood, whatever. I do not recommend tapping the rainy day fund at all. I want to keep it there. As a CFO, we never have enough of a rainy day fund, and that's another restraint and break. I think the real issue is to lower expenditures, operating expenditures and capital expenditures. And everyone should stop trying to find my rainy day fund and all the other funds to pay for things that I feel we really can't afford. You know, think about your own personal budget. Okay, you're saving for your kid's college education and for retirement. And Johnny's graduating high school and he wants a sports car. Do you invade your savings to give them a sports car? And I would say it's imprudent to do that. Yes, you might make it up in 10, 20 years, but the reality is that's what the rainy day fund is for. It took a long, hard time to get there. And I really don't want to spend it too quickly, especially we have ARPA money, we have all sorts of other funds. So you're never going to tell. Yeah, okay.
With all due respect, for the record, I was not necessarily suggesting that we take anything out of that. I was just curious as to know what the budget is there or what the actual funds are. So
Right.
if you could get us that information at some point, that would be great.
Sure.
Councilmember Keegan.
Thank you, Chairman Burnett. Henry, I was listening to you earlier and you said that you had a conversation with department heads concerning some of their capital projects. And did you say that none of them seem to have the stomach to go backwards and maybe take a look at what has already been approved?
Let me be fair. Okay. The Board of Ed and the Department of Public Works has probably 80 to 90% of the projects. So when you start talking to the other departments, they only have a handful.
Right.
And they really do not have the stomach to push it back. It was hard to get that approved. And to them, these are the important things. As I said, DPW tried to push back, but the nature of their expenditures tend to be current already. I think with the schools, there was a small attempt. They might have moved one or two school projects out by 1 year. And I didn't even finish my summary yet. My point was, if I could go back, if we have 220 million and nobody changes, that's 70 million. That's 30 million a year. over 7 years. Our annual capital projects in our budget have now gotten to the point where it's $25 to $30 million a year. This is the paving, the sidewalks, the computer systems, just the regular capital assets that we need to replenish, the vehicles, the roofs on buildings, the repairs. Okay. Then you add that the schools made a projection. We were working with Senator Duff and Costa from the state office that reviews school construction programs and determines how much they are going to reimburse. And we had a discussion, I'm going to say it was about two months ago. And one of the requirements the state said is, please stop telling us one by one, school by school, I need this in the next 2 years, and please show us the whole program. And they did. And they provided a 25-year projection that net of reimbursement will cost $450 million. Okay, that's another 18 million a year. Now, I understand from everybody telling me that there was underinvestment in the past. Past is past, we can't change it. I'm just saying financially, I look at the numbers now. If I have to borrow 30 million for the 220 million of already approved, 25 to 30 million for each year's current budget, and another 18 to 20 for the school's future budget, I got 30, 20, and 25. Okay, that's 75 million a year. That's why I predict within 2 years we'll lose that AAA rating. And Jen, you're right. Same thing, Nora. If we lose that AAA rating and we have AA, we'll be able to borrow even more money. It'll cost us a little bit more, but at least we'll be reinvesting in our infrastructure and all these wonderful capital projects. And the reality is, from a financial point of view, will we get a return on investment such that our property taxes, our reimbursements from the state, and any other revenues will increase to pay for that debt service? Otherwise, the taxes are going to have to go very high to pay for all of this. That's all I'm trying to say.
Just for the record, I'm of the opinion that we should give a real hard look at what capital projects we have on the table and think of what we need versus what we want.
Greg, if you could show the rest of the schedule.
Okay, before I do that, I see Councilmember Hooverman has his hand up, and then I'll show the other schedule.
Okay.
This was just, it was a long-term question that wasn't really about capital. It was about where we're at with the efficiency study on finding some savings within the city, but that.
I'm very pleased to answer because I got good news today.
I like good news.
I have spoken to Betty Ressel, who is the head of the project team at Evergreen, and she told me her target is to review draft report recommendations with the people from the city and the people from the Board of Ed in mid-February, and to issue a final report in mid to late March. And she said that was the target. That's what I'm hoping to do. If there are a lot of changes after the mid-February discussions, may not hit that deadline. But what I am pleased about is I know you good people on the council wanted to get that report before we finish this budget cycle for fiscal year 23. So to me, that was good news. And I'm excited if she can deliver sometime in March. But
Great.
good question.
Thank you. I didn't want to get us off of capital, but it just jumped into my head. So thanks.
Yeah. You're welcome.
Give me a second, I'm getting there. Let's see, let's get it open. Here we go.
Okay. So it's a little voluminous. That's why we have 5 pages worth. And I apologize that. But this is the detail that supports that lead schedule. The summary and subtotals, the way these pivot tables work, are on top rather than on bottom. And again, we have the 7 columns that I told you before. Revised expense budget minus what we've spent to date equals available to spend. In red, we have expected revenue. It's a negative because it will be a reduction of how much we need to spend, but we've already gotten 15 million. Therefore, we are expecting 16 million in the future. So if I take column D, the 214.19 million, and subtract or add the negative 16.097 million, that's how we get 198 million for the Board of Ed. Greg, if you could scroll down just a little bit. Yes, perfect. No, you gotta go down a little bit. No, the other way, I'm sorry. Stop. I wanted to get both. So under the Board of Education, 1 or 2 more lines? Yes. So Board of Education on top, those are project numbers B0291 down to C0790. Those are regular Board of Education expenditures that are not school construction. And now if you could go down a little bit lower, Greg, the building management subcategory, 199.9 million minus 17 equals 187. Those are the schools. New Columbus at Ely, Honus, Norwalk Global, Jefferson, New Cranberry, Norwalk High School, cafeteria, kitchen renovations, and bathroom. And recently, we closed out 2 of these. And we said we were going to use that for the school in Sono. Okay? So that's how you can follow all of the numbers. And you have this level of detail. Then as you go down, just to show line by line, we have it by area in the city. So community services headed by Lamont Daniels. We have corporate counsel is in there for some reason, the health department, the library. You go down a little bit further, we have economic and community development that's headed by Jessica Ivanovich, business development and tourism. The chief has a couple of projects. Code enforcement, parking and mobility, planning and zoning, transportation, mobility and parking department. Then we get to the enterprise funds, parking authority, WPCA we talked about. Finance under me, somehow I got the historical commission and IT. Fire, we have the fire department. We have the police department, which has not only the police, but combined dispatch. Public works, they have facilities. We also have all of these public works projects. We have something called buildings that Public Works is responsible for. Public Works admin on behalf of the fire department, administration, recreation and parks, redevelopment agency. And then we have POCO. So this is out of our official Munis accounting system. You have 270 line items of each and every project. We don't get to 220 million easily. There are a lot of good projects in there, but they all cost money. And now you have the details in front of you, and hopefully we can evaluate them and we can try to figure out how we can figure out how to pay for all of these without increasing taxes exorbitantly.
Councilmember John Kites.
Henry, the council spends a lot of its time working on plans. And once these plans are completed, the individual departments go out and requests capital funding to actually bring these plans to fruition. In my time, I found that little to none of the requests come to light and are completed. I guess I'm asking how much of a part of the conversation are these plans and what the departments are requesting? like how much of the conversations you have during the budget cycle are these initiatives by the individual departments and their requests for capital funding?
Well, what happens is, Tom Ellis and I have been meeting with the departments who have capital requests for this year's capital budget. And we go over each one. They're asked to list them in priority order. So if someone arbitrarily said, here's the amount of money, nothing more than that, we can cut from the bottom, assuming that those are the lower priorities. But we go into it. Why do you need it? How much do you need? We've had situations where people said, I needed 100,000 for a roof, and you only gave me 50,000 last year. I can't build half a roof. I'm asking for 50,000 more. We also have cases when people are asking for additional funds for a project. It could be one of those ongoing projects where we spend money, we know we're going to spend more money year after year. It could be more of a repairs and maintenance type of thing. It could be vehicles. And we sometimes say, but wait a second, as of 12/31, you didn't even touch any of this money. What's going on? So sometimes we've encumbered it. We're going to spend it. We expect to spend it by the entire year. Sometimes it's a question of timing. We have a supply problem that you've heard about. Our vendor can't get the materials. And sometimes it passes June 30. And what we would say on the operating budget, we do a rollover so they have it. With a capital budget, when you get an approval, it's multi-year. So we try to reconcile within a department, across departments. Sometimes we see the same type of item in different areas. So replacing fuel tanks is a good example. We've seen that in Public Works. We've seen that at Board of Education. So there are some common themes. There are things that are out there. So we're the first ones to push back. We then go to the mayor and we say, here's what historically has been there. Here's what they're requesting. And here's what I, the CFO, recommend. And the mayor likes to say capital budgeting is a planning process. And that's why we have 5-year forecasts. And the best example I recall is when the police department changed their radio system last year. And they had told me, we put it in 5 years, 4 years, 3-year column. And eventually this was the year we had to bite the bullet. It was $15 million. I worked with the police and the vendor, and we negotiated that we could pay half of the amount in one fiscal year and half in the next fiscal year to help us out. But what got me is they said, we're going from analog to digital. So going back to the comments that were made earlier by Jen and Nora, deferred investment in capital expenditure catches up. So there are things that what I worry about most are public safety, compliance issues. To me, those are pretty critical. But then I want to try to give our line department heads the resources to do their jobs. But I'm looking for functionality, not the bells and whistles and everything else. The mayor will say, what do you mean you need new cars? You just bought them 4 years ago. Sometimes he says, you just bought them 14 years ago. Keep using them until they drop. Okay, so he pushes back, and then the planning commission gets involved and they take a crack. And on the capital budget side, I believe the Board of Estimate sets the cap, and you people on the council are allowed to juggle the numbers from area to area. The operating budget, it's the opposite. And then the mayor comes out with his recommendation along the way. So there are many, many, many reviews. But the reality is, we're sitting here with 220 million in the back. What I'd like to see is, after this 7-year process, we don't have a backlog anymore. Instead of approving everything and hoping and praying we pay for it, we should approve what's going to be used in the next 2 to 3 years. I can bond the money, we'll spend the money, and then we keep moving, and we don't have this big rock on my back. But we do question these things.
But you can see the frustration of the council, like just some examples, like the Vets Park Master Plan, Freeze Park Master Plan, Oyster Shell Master Plan. You know, these plans have been in place, they require capital funding, and then nothing ever happens because obviously these, and I will say, more important necessities, oil tanks, other, you know, capital expenses that take priority and rightfully so. You know, I just think moving forward, seeing the council spends much of their time drafting plans, I guess I'm just trying to say maybe we should, before we jump into some sort of master plan that we know is going to have a price tag attached to it, we can actually figure out, is it worth it to do it at this time, knowing that we're probably not going to have any money to do to pay for it, and you know, and kind of plan that out moving forward, because like you said, Henry, all these department heads come to you with all this low-hanging fruit, and it's unfortunate that only the items with the lowest price tags, you know, if any, get any funding allocated to them. So I don't know, I guess it's just something I've noticed over my time on the council. So I'm just thinking maybe there should be a plan, a long-term plan, and maybe some input from the finance department to say, hey guys, you're about to invest this money into this plan months and months and months, and you're not going to have the money to do anything. And then most likely in 5 years, you're going to have to pay that money again because the plan you have is obsolete. I mean, I think there's a place at City Hall where you've got dozens and dozens of plans collecting dust that no one's ever looked at, you know, but so I always appreciate your honesty and your candidacy. You know, you're always, you know, up and up with everything. So I appreciate that, Henry.
I try, thank you. I appreciate your frustration. We're frustrated also, and there's got to be a better way because we're on a bad path financially, and we got to figure that out.
Yes, council member.
Mr.
Jen McCarthy.
Dakowitz, thank you, Mr. Burnett. Mr. Dakowitz, what would be your ideal number to, if we went through line by line? I'm assuming that's what we're gonna get at, is that the council or this committee needs to go through with the departments. I don't know what the process would be for this, but what is the magic number to get the capital improvement budget down to in your eyes, so it's healthy?
No, I appreciate that. I'm not looking at a magic number. I think that's the wrong way to look through the telescope. I think the right thing is to evaluate the projects, as Chairman Burnett said when we started. It says you look at each project and you say, maybe you do a first pass through just so that you get a flavor of all the many projects, especially new members. I was astounded at all these different projects. And when people come in asking for money, you know, I want to say yes to everybody, but it's hard. So the first order that I try to do is I try to get the departments to give us priorities within their department. And then the chiefs, who may have 3, 4, 5 departments underneath them, they should be the ones to say, okay, project number 3 of my department number 1 is more important than project number 1 of a different department. So they can do some prioritization within their area. And then what should happen is, what I really love to see is a review that says, this is critical, we've got to do it. This one, maybe we can slim down and change the scope and cut some money out of it, and we don't do every single thing that's incorporated it. Then there's what I say, and it's hard to identify the difference between the Cadillac and the Volkswagen. Things get padded. When I was treasurer of Nassau County, I understood from the head of public works, they had a program that needed $3 million. They went top of the line and it cost $6 million. They said, you know what, we might have cost overruns. Let's go to 8. So on my budget, they said 10 million. They don't want to have to go back to the finance guy. So a $3 million project became 10 million. And if everybody does that, that's when you start getting numbers that are out of control. And I think you have to ask the tough questions, and you have to push people to say, no, you can't have everything. I'll just say one of my pet peeves is every new school needs all new furniture, everything deluxe, top of the line. I think it's outrageous. I grew up in Brooklyn, New York, in a 50-year-old school with 75-year-old desks. and we got educated. And I think there's an attitude here of we want the best, but there are financial constraints. And I know it's very hard to figure that out, but that's what I would do. And then some of them maybe get stretched out, says, you know what, we'll get to you in 5 or 10 years, but not now. Let's see how the grand list goes up. Let's see what our revenues look like. And then some get eliminated. And I think you can only do what you can do. And I don't know whether at the end of that, the total is 200 million or 150 or 100. I would not set a number. Objectively, do the work project by project and see what you come up with. And I'll try to figure out how to manage it financially.
Councilperson Diana Revelous.
Feel free to call me Councilwoman. I just wanted to say that I do appreciate this review, and I think as people who live and work with budgets, it makes sense. I just want to show that at the end of the day, the people who get hit the most is the people who live here, who are lower hanging fruit, who can't afford all these top of the line extra stuff. And I want people to understand that there's a community here that this is going to fall on if we don't control this. Right? Everything sounds great, looks great, but at the end of the day, if our taxes go up, there's a huge community that's affected by that who need the same things you're saying we need to pay for, you know? And I really think that should be the front line of what we're thinking. So we then make sure what we're paying makes sense, not just rigmarole, not just to make it fluffy and pretty, but these are people who are paying this. It's not just borrowing this and that. People who live here are paying this. And you can actually put out Norwalkers who live here because they can't afford what you're asking to make brand new and beautiful. And I really just I strengthen that all the time. You know what I mean? In everything we do, and just thinking about what we're financing, thinking about what we're looking at, really coming down and saying like, we can handle this, maybe not this, because at the end of the day, those are your children and your families here that will not be able to afford it and will leave Norwalk. So I just think that should be top of everybody's mind. How does our community pay for this? That's all I wanted to say. And I appreciate this presentation so much.
Let the record show that Council Member Nicole Ayers has joined the Finance Committee meeting. Hello, Nicole. Are there any other questions as it relates to, yes, Councilmember Keegan? Are you muted, Tom?
I got it. Thank you, Chairman Burnett. We discussed this just a bit ago. Henry, on the first page of the this guy,
The detail?
under community services,
Yes.
the account is CO 634, which is for the South Norwalk Community Center.
Yes.
Chairman Burnett and I discussed this a bit a week or two ago. City of Norwalk appropriated $500,000 for use on that building in partnership with the Riverbrook YMCA. The state of Connecticut just gave us a grant of $1.2 million. Why did that not, or why didn't we use that to offset our $500,000? Did that go directly to the YMCA's? None of
May Lamb is on the phone, our controller. She might know the answer better than I.
Well, we haven't seen that. I mean, we'll reach out to the department head and see if that is something that the city will receive. Anything that comes to the city, we would be aware of it. But as of right now, I don't know. We haven't seen that money yet that came in.
And I think that
Just to further clarify, that on this particular item, that $500,000 came from the restricted funds that were allocated from the Sono Mall. $3.5 million was placed in a restricted fund to be used for improvements within the South Norwalk area. And out of that fund, the $500,000 was used from that fund for the fit up of the YMCA. So, so there's money remaining in that account, which will go towards the MLK corridor as part of improvements that will be made in that area. So that's just to give some background as to where that 500,000. But to your point, Council Member Keegan, yes, the YMCA did receive a recent grant, and clarification, I guess, is needed as to whether those funds, is it a transfer through the city to the YMCA, or was it awarded directly to the YMCA, which I believe they're going to use on facade improvements and some other renovations in that facility.
Yeah, my question would be, did the state give it to the Y or did the state give it to the city? And I think that's the question that I would ask be answered.
So maybe you could follow up on how the funds went, where they designated, and respond next time.
Yes, we'll follow up and send an email out.
Thank you.
Any additional questions as it relates to the capital budget and the information that was presented? And clearly, as Henry indicated, it's a lot of information. This will not be the only discussion, but we wanted to provide headlights as to where we're at, where we're heading, and what issues we need to address as it relates to the capital budget, because this is an area of concern, but the fact that we're having discussion and we're aware of it is trying to resolve the situation, or at least get a better handle on it, as opposed to letting it spiral out of control, and then all of a sudden where it's in front of us and it's like, how did we get here? So we're approaching this with our eyes wide open. So yes, Councilperson.
I'm just wondering
McMurray.
what our next steps are. I know we're going to continue to have conversations around this, but is there anything that we need to take as a next step as a committee or as a council? And is there, I'm such a deadline driven person. Is there a deadline we would like to put on any of these next steps? Sorry, that's just who I am.
Thank you. I would just say, for me, it's uncharted territory. Okay, haven't done this before. I personally think the elected officials, the mayor and the council, have to wrestle with these very tough choices. We generally borrow money in the summer. Last summer we borrowed in July. Often we borrowed in August and September, because in June there's a lot of maturities. People have cash, so it drives the interest rates down a little bit. I think it really would be very helpful if I knew that the 220 million was a little bit lower, or if there was agreement that some of these projects would be pushed out further so that I can borrow less. I want to borrow enough to make sure that as we perform these capital projects that we have sufficient funds, but I really would prefer to borrow less. I've seen the initial indications for our current capital budget, and we're going to be in the $25 to $30 million range. You may recall a couple of years ago, we had about 240 million of capacity before we hit the 400. And I said, what I'd like to do is do 40 million per year for 5 years. That's 200, and 8 million per year for 5 years. That would buy us 10 years before we might lose the bond rating. We're 3 or 4 years into the 40. And to your point, Nora, that 40 or 42 million became 50, because each year I saw the rates and I said, I got to grab more. And I also grabbed some money for the WPCA and for the parking authority. So I try to be opportunistic. but the IRS handcuffs me a little bit. So we're running out of capacity. I'd like to borrow a little bit less if I could. I put the 7 years out there. Maybe people say we could do it over 10 years. So that's 20 million a year instead of 30. That helps. And if we could rationalize these projects, and I don't know whether we're capable of doing it. Maybe we need a consultant to come in and say, look at these designs. Can we get rid of the bells and whistles? I don't know. I'm willing to pay 100,000 to get someone to tell me you don't need to spend $5 or $10 million. That's part of what we're doing with the efficiency study. We're paying these good people to use their expertise to tell us, here's where we can gain efficiency. I think this is a worthwhile effort. I think it will pay off. And I think we could all know when we get to the end where we say, these are our true priorities that we all agree with. And this is how much we can afford. And this is how we're going to space it out. The problem, as you all know better than I, is that decisions are not made only financially. There's a lot of politics that goes in, whether it's district by district, whether it's which department in the city is supporting something, who speaks to someone at the last time, and that's the one who has the inside track. I don't have to describe this to you. You were far more knowledgeable about politics than I ever will be. I'm just the finance guy trying to make sure the household budget lasts and stretches. So I appreciate the investment of time and effort that you do. I'm here to help, as my staff are, and we'll try to muddle through. But if you could set up some meetings to start looking at these projects on a line-by-line basis, that might be a good first start.
Thank you, Henry.
To do it by,
So
Jen,
do-
if you need to do it by next Thursday, if that'll help you, I'll give you a deadline.
I'll do my best. I've never missed a deadline before, but that might be aggressive.
Okay.
Thank you for that, because we do need to take a moment and assess what are the next steps. They're not 100% clear right now. We're in a new capital cycle right now, where requests are coming in. So it's a combination of looking at those new requests that will come through the Economic and Development Committee before they get to the Finance Committee. So it's a combination of looking at what's coming in new, as well as the information that's been presented to you tonight in terms of current projects. So several more discussions and meetings to come. But the bottom line is some difficult, thoughtful decisions need to be made in order to improve our situation. So with that, if there's no other questions, before we call for adjournment, just want to mention again that pencil in your calendars that we will have a special meeting next Thursday at 7 o'clock, and pending the advancement of the special capital appropriation to the Planning and Zoning Committee, we will have a special meeting to address the funding for the new South Norwalk School. So that will be next Thursday at 7 o'clock. So with that, if there's no other questions or comments, motion to adjourn. Okay, Councilwoman Diana Revelous, thank you. All those in favor show by the sign of aye. All those opposed have the same right. Any abstentions? Thank you. We stand adjourned, and have a great rest of the evening, and thank you
Very
for
much.
your input.
Thank you for
Thank
all
you,
your
everyone.
time.
Thank you very much.
Have a good night.